Okay, so someone is, of course, this is pretty common. They want to set up a company in one of the Emirates, right, in a free zone, and they're asking about the tax implications, the U.S. tax implications of doing so. Of course, setting up a company is a pretty common means of not just of running your business, but also of getting residency in certain Gulf states. So because you can form your company, and that company then sponsors your visa and your Emirates ID or whatever the case may be. So that is pretty common. But of course, it's a good thing you're asking, because it could have tax implications depending on your situation, right? So we look at it in terms of generally speaking. So this is, again, we're being very, very general, and you need to get advice specific to your situation. But generally speaking, we look at it where you own or control, you as a US exposed person, own or control less than 10%, where you own and control between 10 and 50%, and when you own and control 50%, more than 50%. And when I say you, I mean someone that's US exposed. So if, for example, you may have 30%, but there's another US exposed shareholder that has 30% as well, together the US shareholders control more than 50%, and then that triggers a certain tax treatment, right? And that's a tax treatment that you really need to look for. This where an entity is controlled by U.S. persons, and that's the control foreign corp, because you trigger what we call CFC rules. But anyway, if it is that you have less than 10%, then typically that is okay to the extent that there is less impact on your U.S. tax return. And what do I mean by that? You would, depending on your situation and depending on what your other financial assets may be, it may trigger disclosure on the Form 8938, which is a disclosure of foreign financial assets. There are various thresholds, but that's one form that you need to look at. But the good thing is that it's kind of like your FBARs, in that it is an asset declaration. It doesn't necessarily trigger a tax liability. So that's an important distinction to make. So that's the 8938. There is something called a PFIC, or passive foreign investment company, which is it is quite nuanced. It's when, so again, we're talking about where your interest in a foreign entity is less than 10%. So a PFIC is a designation you're looking for. It's a designation in the tax law that was created in the 1980s, I think, under President Reagan. So it's code section 1297. So this is where 75% of more of the gross income is classified as passive of this entity. So 75% or more. And what do I mean by passive? Could be interest, dividends, capital gains, stuff like that, but it's passive. Or 50% or more of the assets are held for the production of passive income. And that typically involves real estate or something else that would produce the passive income, which we discussed previously. So if you have that PFIC designation, suddenly it crosses from being an asset declaration to something that can have a real tax impact. And what do I mean by that? You may be subject to one of the anti-deferral rules. So in the US, in the US tax law, there are three types of income anti-deferral rules that you need to kind of keep in mind. There's this PFIC regime, which we're talking about now. There's the subpart F, and there's guilty. We'll get onto those other two later. So we're talking about your interest is less than 10%. And if you add up all the other American US exposed shareholders, your collective interest in this entity does not exceed 50%, right? So less than 10%. If you trigger this PFIC status, that means that you can be subject to tax on phantom income. What do I mean by that? If the value of the company or the underlying assets or whatever, depending on the structure, if it increases in value, even though you did not get a distribution, even though you didn't take any dividends, you didn't take any interest, whatever it is, even though you didn't get a distribution, the value has gone up and you may have to pay tax on that phantom gain. That's a paper gain. So that's a really rough way of describing the PFIC rules and why it's something to be careful with. There are ways of legally avoiding it, which you can discuss with your preferred advisor, like there's a check the box election and stuff like that. So have a conversation with your preferred advisor, but keep in mind 10% or less, you may be exposed to PFIC rules, but definitely depending on your other assets, disclosure under 8938, on the Form 8938. So what happens if you have ownership or control of between 10 and 50% in this foreign company, and there are no other U.S. shareholders, just you, and it's between 10 and 50%. Notice I said ownership or control because I know people like to use nominees. That's a common part of a corporate structure, not just in the Gulf area, but other parts of the world as well, like in certain parts of Southeast Asia, where we have quite a few clients. So when I say control, it keeps in mind, or it also extends this conversation to those nominee structures. Even though on paper you may not be there, if it is that you have that, if you have the ability to, exercise influence, you have a share of voice, maybe not a share of value on paper, but share of voice in between those thresholds, this would apply to you as well. So you're looking at disclosure on, if it is you made an initial investment, it may trigger a Form 926, as well as the existence of your shareholding or your interest or your voice in this foreign entity may require disclosure in a Form 5471. But it's not like the PFIC. Usually it's not like the PFIC where you may have to pay tax on phantom income. So it's just a disclosure. And so it doesn't normally have an impact on your tax liability. Now, keep in mind that international tax, from U.S. international tax, is counterintuitive. And what do I mean by that? I mean that typically you would imagine that the Internal Revenue Service pays greater attention to someone who doesn't pay their taxes, right? That just seems to be logical, but it's the IRS is not very logical sometimes. And we know that it's a bit counterintuitive because they seem to focus more on when you do not disclose activity outside of the US, so investment activity or assets outside of the US. So for example, if you don't pay your taxes, then of course, penalties or interest or whatever. But if you don't disclose like a financial account, that could be up to 50% of the balance in the account. If you don't disclose the existence of your investment in this company in a Form 5471, then you're looking at $10,000 per failure to disclose. That's not a small amount. And if you have one or two free zone companies, like many people do, it just happens, right? That could be $20,000 each. And in terms of the balance in the accounts under the FBARs, up to 50% of the unreported balance. And there's a famous case in Florida where, at least famous for us, where we really got up and paid attention a few years ago, where this guy, I think he was a dentist, and he had about $1 million in an account in Switzerland, which the IRS deemed that he forgot, or I think he was non-willful in not disclosing it over 3 years. But the point is they went for the maximum. So he was given 3 years, $1 million, so $500,000 each. So his penalty was $1.5 million in an account with $1 million in it. So my point is that in U.S. international tax, pay special attention to disclosing your investments and disclosing your holdings outside of the US. Not just paying your tax bill, but disclosure is really, really important. So circling back to where we were, that company which your interest is between 10 and 50%, then you really need to pay attention. Make sure you get your 5471 in for your initial investment, your 926. To pay special attention to that, because the penalties could be pretty aggressive. And if you have signature authority over corporate bank accounts, like many people do, even though it's not in your own name, but but you can sign for it. And even if you're signing authority means that you can't sign a check on your own, or you can't sign for a transaction on your own. It'll be you plus another director, or you plus another C-suite exec. It needs to be declared in your FBAR still. So let's pay attention to disclosure. So last but not least, it will be a corporate structure where your interest is more than 50%, or you plus the other US exposed shareholders exceeds 50%. And by US exposed, not just if you have a US passport, but if you have a green card as well. Or alternatively, it could be you have, Section 7701, substantial presence. You spend a lot of time in the US, and intentionally or unintentionally, you trigger US tax resident. So if it is that it's more than 50%, you have what is called a CFC, or controlled foreign corp. And suddenly it's not just about disclosure, but there may actually be tax implications. So you may actually trigger certain tax consequences, not disclosure, but a higher tax bill, if it is that you have a controlled foreign corp that hasn't been structured in an optimal way. The three regimes that you'd want to pay attention to would be the Subpart F, which came around, I think it's in the 1960s. What else? Under the Tax Cut and Jobs Act, you have GILTI. So I think those are the main ones. We spoke about PFIX already. When it's a CFC, if it's an entity which can trigger both PFIC and CFC rules, then CFC rules tend to win. So you look at CFC rules. We've already discussed PFIC. So it's a CFC, it's a controlled foreign corp. You have a controlled foreign corp as a US exposed person in one of the free zones. What are the implications, right? You could have what is called a Subpart F income. And what is Subpart F? That's under Section 952, I think, of the US tax code. So this is a classification of certain types of income. So this is where you have the interest in the foreign company, and it can trigger Subpart F status in one of several ways. There's insurance income, there is foreign-based company income, there's foreign-based company sales income. So basically, if your company is established in one jurisdiction, but that same company is doing business in another jurisdiction other than the one in which is incorporated, and especially with a related party, that could, under certain circumstances, trigger Subpart F. That's Section 952. And then more recently, in President Trump's Tax Cut and Jobs Act back at the end of 2017, you have the creation of GILTI, which I think is Section 951A. So this GILTI is global intangible low tax income. And what it does, it as the name suggests, it focuses on entities that have been incorporated in lower tax jurisdictions. For example, one of the Gulf states, which is obviously very low or zero tax, depending on your structure. And it imposes a minimum tax, which is around 10.5% at this point in time. It's a rather complex formula based on tested income and stuff like that. But essentially, even though under both the Subpart F rules and the GILTI rules, the point is that you would have imagined that this company is only taxable to you as this shareholder when there's a distribution, either in the form of dividends or in some sort of salary or compensation, director's fees or something like that. And you would have thought if you were to leave the money in that company, then it would not be taxable to you. So the bad news is under these regimes, it will be taxable to you. So even though you did not take a distribution, you are deemed to have taken a distribution. So again, it's a situation where you're paying tax on phantom income that you did not receive. Now, you're not going to be double taxed. So you're not going to pay tax on the money that's earned. And then when you take it out, you're going to be taxed again. No, you're going to create a pool of previously taxed income within the company. And then when you do take that dividend out, they do take that bonus, then you get to offset the tax already paid, and you just pay the delta, you pay the difference. But my point is, and I know it's a pretty long-winded answer, that when you have that company in the Gulf area, in the UAE, in Dubai, wherever it may be, you'd want to speak to your advisors to understand, hey, what are the tax implications? And perhaps there would be planning opportunities, ways to plan and to structure it in which it would reduce the compliance burden upon, the time you need to do the returns every year, and the price associated with that, obviously, as well as the tax liability. So those are the factors you need to consider. I hope that helps. Get advice.
So if you're a 6, 7, or 8-figure investor, entrepreneur, or business owner who needs a tailor-made solution from a qualified team of professionals, we can help you achieve the international lifestyle, the freedom, and even the tax savings you're looking for. Visit us at htj.tax and live that international life.